Why did retail traders lose 8,000 Indian rupees crore on Dalal Street right before a historic 17% rebound? On July 28, Sensex crashed 10% in morning trade, triggering an emergency circuit breaker instantly. Panic hit millions of demat accounts as traders sold everything in sheer terror. Yet, just 3 trading sessions later, Nifty logged its biggest single-day surge in 46 years. So why do retail investors always dump their stocks right before the market bottoms out? On June 22, Sensex closed at an all-time high of 9,114 points amid massive media celebration. News channels cheered while trading desks rang ceremonial bells to mark the peak. Retail investors poured over 2,140 Indian rupees crore into shares on that single expensive day. Meanwhile, foreign institutional investors quietly pulled out over 2,500 Indian rupees crore. That massive gap between retail optimism and institutional selling reveals the first major trap. Think of the market like boiling chai in a heavy copper pot. Traders wait patiently while it warms, but jump in only when it boils over. Because they buy when prices are hot, they panic the second the flame cools down. Smart institutions accumulate quietly when markets are cold, leaving retail traders paying high fees. That behavioral pattern leads directly into a documented psychological phenomenon. A 2020 study of 200,000 Indian demat accounts exposed a painful psychological pattern. Retail investors were twice as likely to sell winning stocks than losing ones. When a stock jumps 20%, traders rush to book profits just to feel validated. When a stock drops 20%, they hold on indefinitely to avoid admitting a loss. This disposition effect leaves portfolios filled with deeply bleeding holdings. Holding losing stocks for months creates unbearable psychological pressure. When drawdowns hit 40%, emotional endurance breaks completely. Investors dump their entire portfolio at the worst possible moment during market capitulation. Ironically, market bottoms form precisely when the last desperate retail seller surrenders. The exchange data shows a stark divide between new market entrants and experienced veterans. Data across 204,000 broking accounts showed that 62% of first-time investors lost capital. In contrast, experienced market veterans achieved an average positive return of 15%. New investors traded at twice the turnover rate, incurring massive brokerage and taxes. Emotional decision-making continuously chipped away at their account balances. Much of this hyperactive trading stems from recommendations spread across social media. Herd behavior spikes whenever viral stock tips flood WhatsApp groups and social channels. By the time a stock tip reaches casual group chats, early institutional buyers are exiting. Retail investors buy en masse right at the peak due to social proof. If you have better insights than this video, please leave a comment, like, and subscribe. While buying peaks hurts, adding debt to emotional trades turns losses into total destruction. In June 2026, Indian margin trading funding reached an all-time high of 38,632 Indian rupees crore. That leverage level was 67% higher than the peak of the 2021 bull run. Leverage amplifies gains when markets rise, but it obliterates accounts when prices fall. If stock prices drop below margin maintenance levels, brokers issue urgent margin calls. Failing to deposit funds immediately triggers automated liquidation of your shares. Forced liquidation takes execution control completely out of the trader's hands. Brokers dump shares automatically at market price during steep market drops. Thousands of forced sales executing at once trigger a cascading market crash. Forced selling spiked sevenfold to nearly 1,000 Indian rupees crore in the first half of the year. The demographic impact of this leverage trap hit vulnerable groups hardest. Over 20,000 individual demat accounts faced forced liquidation within a single month. The fastest growth in margin liquidations occurred among investors aged over 70. Retirees lost life savings on borrowed funds right when recovery time was shortest. At the same time, young traders entered high-risk single-stock leverage products. The launch of exotic derivative products created unprecedented daily volatility. When single-stock leveraged products launched, retail buyers poured 8,200 Indian rupees crore into them. On Black Tuesday, 14 leveraged products crashed by an average of 25% in one day. Because traders bought single-stock derivatives instead of index funds, losses compounded rapidly. If a stock dropped 10%, the 2x leveraged product wiped out 20% of capital instantly. This rapid decline stems from a mathematical trap known as volatility drag. Daily leveraged products resets mean long-term compounding works against the trader. If an asset gains 10% then falls 10%, a 2x product loses 4% overall. After a 50% drawdown, an asset needs a 100% gain just to break even. Regulators stepped in on July 31st, imposing strict 30 Indian rupees lakh minimum deposit rules. Beyond leverage, placing all your capital into a single hot sector creates equal danger. The third fatal mistake is concentrating entire savings into just one or two stocks. Indian investors added $5.3 billion to US equities, yet total holdings shrank by 16%. While the S&P 500 dipped under 2%, retail portfolios fell double digits. This drawdown happened because money was concentrated heavily in volatile tech leaders. Domestic portfolios on Dalal Street faced the exact same overconcentration risk. In mid-2026, 3 major stocks accounted for over half of Nifty's market weight. Retail investors mirrored this concentration by stacking portfolios with IT and banking shares. When sector headwinds struck, diversified protection was completely absent. Chasing fast returns in single sectors turns investing into outright gambling. India's greatest business leaders survived market crashes by following very different principles. Ratan Tata famously advised taking decisions and then making them right through resilience. Mukesh Ambani built reliance by managing downside risk before scaling big bets. Great industrialists focus on surviving hard times rather than chasing overnight riches. They maintain cash reserves so market crashes become strategic opportunities, not fatal blows. Retail investors can adopt this exact institutional mindset during market cycles. Retail investors are not inherently wrong. DII inflows stabilized Sensex through major crashes. Foreign institutions sold heavily for 24 consecutive days, yet domestic flows absorbed the panic. Even global funds mistime market turns during macro market shifts. Survival on Dalal Street depends on discipline rather than predicting market directions. Implementing 3 practical rules can safeguard your portfolio against emotional errors. Rule 1. Write down exact exit rules before clicking the buy button. Define clear target profit levels and strict stop-loss limits in advance. Once emotion enters a trade, objective decision-making becomes completely impossible. Preset rules eliminate hesitation, forcing you to cut losses before panic sets in. The second rule protects your most valuable asset during market volatility. Rule 2. Never trade with high-cost leverage or borrowed money. Wealth creation requires holding quality assets long enough for compounding to work. Margin debt destroys time by giving brokers the power to liquidate holdings. Trading only with unencumbered capital allows you to ride out severe drawdowns safely. The final rule keeps portfolio risk balanced across all market conditions. Rule 3. Cap single stock exposure at 10% and automate rebalancing through SIPs. Enforcing strict allocation limits forces you to sell high and buy low mechanically. Systematic SIP investing removes emotion, ensuring steady accumulation during market panics. That's why structural discipline on Dale Street matters far more than market timing. Ultimately, controlling your own behavior determines your long-term investment success. Market tops and sudden crashes remain entirely beyond any investor's control. Retail losses stem from panic selling, heavy leverage, and over-concentrated bets. Mastering your psychological reactions turns market panics into generational wealth. Focus on managing your own rules, and market success will naturally follow. Will your current trading rules withstand the next inevitable Dale Street crash?